Hello, to the G22 report. I'm your host, Johnnie Market. Y'all know that drill. Smash that like button. Subscribe if you already haven't. And just disclaimer, nothing said on this podcast or video should be construed as financial investment advice, just my opinion, thoughts on the market. And just going back, first thing I wanted to get into, there was nothing big over the weekend. So I wasn't going to do anything Friday on the economic data. But if you look at it, the market, I was just reading this US households, mutual funds, pension funds, and foreign investors. Now, I've talked about this with foreign allocation to stocks has hit a record 54%. If you look at it like stocks, debt, cash, debt is like bonds. And this is exceeds the dot-com bubble by 3 percentage points. And, bonds and cash allocations are at near all-time lows. Investor exposure to the US stocks has never been greater. So if you look at that and then combine it with this, this came across my thing. I said most Americans are dissatisfied with their surveys. 22% Americans are completely satisfied with the amount of money saved. Just only 22. And they said inflation was the top concern, leading to the increase of cost essentials such as housing, groceries, utilities, straining household budgets. Now, the main reason inflation comes, they can say whatever they want, but it's because they won't let the markets crash. I remember when I used to be a gold bullion salesman, everyone's like, where's the inflation? Where's the inflation? And it was around like 2013 through 16. And I always told people it's in the stock market. It's going to come down to the real economy eventually. And then here it is. Credit card debt has reached record highs. Rising interest rate on credit card and loans made it harder for consumers to pay down balances. So I just don't believe this. Excess savings accumulated during the pandemic. I don't think people saved during it. I don't. Maybe some like really rich people. So on average, it looked like people saved, but I would say most people, if you did it by just class, like lower class, middle class, upper middle, I would say most people probably didn't. And if you adjusted it for population, like upper middle is probably like 10%. So And so, yeah, they partnered with a Marist poll for 3,000 adults. And these are just the respondents. Like, they saved less than 20. I'm just going to do the two-thirds say that the cost of living is not affordable. That's two-thirds. And this is one reason that eventually, if you look at what I just did, they talked about how people are leveraged up to have so much in their stock markets. Well, eventually, if they're having these types of financial troubles, especially with debt, they're going to have to sell. That's one thing that's never talked about. Are these people going to have to really liquidate to pay down their debt, especially with rising rates? So that's the first thing. And this is just a chart, cost of living. 5% say it's very affordable and only 28. So that's, if you combine that, that's 33%. 45% not very affordable and 22 not affordable at all. And only 1/4 of Americans say they live comfortably. So that is, look at this. Women are more dissatisfied. I'm surprised because I don't know. I thought men would be more dissatisfied. I don't know why. So, and look, they saved less than 2024 compared to 2023. So you can see people are saving and saving less. And and that's just all and here it is. Cost of living is the most significant barrier. So you have all this, and then not only do you have all this, not only do you have people not saving, but you have all this in the stock market. Eventually, what they're going to have to do is sell their stocks to pay down their debt. Especially if they lose their job, they're going to have to sell their stocks and pay down some of their debt. And I mean, I bet you most people, they don't say how people own stocks. Like, that's the thing. They're like, oh, foreign funds or mutual funds and everything are have their highest allocation towards cash, which may be true, but how many, and they talk about most Americans, how a lot of them own stocks or whatnot, but how do they own them? Like if you're 50 or 40 years old or 35, do you own your stocks, meaning you can sell or get rid of, or do you own them in a 401k? That's what I'd like to know because most Americans, I think, have their wealth in their house and their 401k. I don't know how many people have like a brokerage account, and there are probably a good amount, but I don't see it. I know you see it on through social media and whatnot, but I just don't know if that is the majority. But that's the first thing I want to get to is if you look at leverage, people are highly leveraged. And the reason they're not selling stocks despite all this debt is I think there's FOMO, which is fear of missing out. I didn't know what FOMO meant. And FOMO is a big thing. Look at this. A third of households can't cover 1 month's worth of bills if they lost their job or a source of income. So they probably count like people that own their own business or social media. And here it is, Trumphoria. 60% of Americans are more optimistic about their finances with Donald Trump as president. So we have, as I said, we're in Trumphoria too. And that's one thing I wanted to also show you. So you look at it, there's tons of FOMO right now. And the savings rate's been poor. I've seen a lot of problems. And if people are have all this FOMO where it's like the allocation is at hasn't seen since the dot com. Does that mean we're closer to? I'm not saying this is the top, but we're closer to a top than we are a bottom, in my opinion. So the other thing I wanted to share with you is I talked about this on this channel, and this is why the miners haven't been doing well. I'm convinced everyone talks about speculative money. Now, like the explorers and developers, they never have net incomes. So that's true. But I'm going to compare two miners. Very different results from last year. And just to show you, we're going to start off with Newmont Mining. And if you look at, and this is why I'm saying sometimes you just got to get back to the basics. So we're going to go, where is this London Metal Exchange? Operating. All right, so this is we're gonna do a couple of things on the operations. Where is all right, balance sheet cash flow. Where's the income statement? Comprehensive. All right, I'm gonna go. Sorry, I should have balance sheet cash flows. All right, they may have called it statement of operations. So sales. And if you look at net income attributed to stockholders this time was 922. It's, in the millions. Around this time last year, it was 158. So it still had a positive net income, but it was not the net income. And if you look at earnings per share, 80 cents compared to 20 cents this time last year. Now, a lot of that has to do with the rise in gold price. And you can see it here, net income 924 as compared to 163. And but if you look at the balance sheet, 55506 was the amount of assets. This year it's 56175. Liabilities 26279. Last year 26301, which is not really all that much different. But the one thing, if you look at retained earnings, last year was negative 2996. Still negative, but it's 2101. So you can tell that the net income has gotten stuff down. But the balance sheet overall, just assets, liabilities, I do normally a lot of ratios, but I haven't done them in a while. And you look at current assets, that's increased. Cash on the balance sheet, but if you look at this uh, income, the statement of cash flow, you'll see there's not all that much. And you can tell they're buying back stock. 1854 is how much common stock. 1840, so they are buying back some stock. And if you look at the cash flow, you can tell. I just did this and do it on my phone. The free cash flow, just using uh, operating cash flow minus capex, which is the basic one, but 2147 minus 1746. Doing this right here minus this right here. That was 401. And obviously that's not the number, it's within the millions. But then using this one, 3852 minus 2527, that's 1325. So has free cash flow, like depending on what you wanted to do. But here's the thing, like you can see it's paying down its debt, but here proceeds of issuance. So they're actually issuing new debt. So they paid down debt, which isn't something I really like to see. And you can see they're buying stock. But if you look at it, cash at the beginning, 3,100, cash at the end, 3,050. And I would say this company like maybe needs a dividend cut or you can say about they have a net income. Look at that depreciation, which is non-cash. But this is the one thing I really didn't like was they had to borrow, they pay down. It's like a refi, and you can tell they're repurchasing common stock. They're paying dividends. But one thing that was on their balance sheet, I'm gonna go back to their balance sheet. That was interesting. And this is the one thing I looked at note 5, liabilities held for sale. They won't have that. This is going to eventually, these are non-cash, but it's going to hurt their earnings in the future once they get rid of it because they are selling off non-core assets. But if you look at it, it's not all that different despite the thousand. They do have a higher net income. But if you look at it from a cash flow standpoint, there's red flags. And if you look at it from a balance sheet, it's not all that different. This is Newmont's quarter 3 10Q. And if you look at it, I did a 1 year. It's only up 15%. You can tell the net income and the free cash flow was a substantial improvement, but everything else hasn't been improved. And so that's why it's only roughly 15%. And the reason I'm doing this is everyone talks about like Bitcoin and everything else. And I brought up the royalty and streaming. But on the whole, you look at some of these like Newmont, which went from now at one point it was at 58 and it's corrected, but it's not all that much. But then if you look at New Gold, on the other hand, which is different. Now I own this for disclosure reasons, but I saw it was turning around and so I bought it. if you look at it around this time, last year, from doing quarter 4 hasn't come out. So this is the most recent up to date. They were losing 2.7 million on the income statement. But now their most recent, they have a 37.9 uh in the millions, in the net income. So their net income has improved drastically. And if you do 9 months, 47.5 as opposed to negative 37.1. So you can tell there's a great improvement in the net income. And it's still here, 37.9. And then if you look at the balance sheet, now the retained earnings 2,345 instead of 2,412. That actually has gone down, but remember they were probably losing money in other quarters too. But if you look at it, assets 2,286, but that's also declined. But if you look at the liabilities, which they probably used a lot of their assets to, I mean, they were selling a Terrius mine, so that would they used it, sold it, paid down a lot of debt. And if you look at the current like trade and other payables, 229, now it's 196. Obligations 123, that's not a significant one. Long-term debt, that actually has increased. But like deferred tax liabilities, 74 to 44, that's decreased. And derivative financial liabilities, if you look at that, 667 to 169. So they have delevered. Now they do have more long-term debt they have to pay down, but if you look at it, they have, the derivatives, the non-current derivatives, they've really paid that down. And this is other things. Where's the statement of cash flow? Statement of cash flow, if you look at it, 1279, which is higher than the 100.1, and then this is the thing, is that instead of doing capex, they do mining interest. So instead of 70.6, this year it's 62.5. So if you look at it, operating cash flow is significantly higher. Capex, it's lower, and so free cash flow is drastically higher than it was this year. So you can see that New Gold is actually free cash flowing more. And look, they're even paying down their credit facility. So cash in where's cash in the beginning of the period? Well, I can just go to the balance sheet. I don't but yeah, you can tell the cash is coming, even though they're free cash flowing, they're still uh burning cash, but oh, there it is. Cash in the beginning, 184, cash at the end, 132.6. So you can tell, even though they're using cash to pay a lot more, just if you do the traditional operating cash flow minus capex, they're free cash flowing a lot more than this year, last year. And their net income was drastically higher. And you can tell with the stock price right here. This is up on a 1 year basis, 100%, which is quite a move. And I can tell you, I've enjoyed that move personally. But not bragging or anything, just what happened. I had good luck. But you can tell what was improving: cash flow, uh, net incomes. Their liabilities were drastically coming down. And this is what I'm saying is that a lot of people will say what's hurting the miners and why gold miners are not doing well. It's because, there's so many more speculatives and whatnot. Gold has had quite a move. Like if we go up to, let's just go to GLD. Now I don't, but if you look at GLD for 1 year, people forget. Let's just do GLD. This is a 32.65%. Let me so you can see it. GLD. If you look at it, it's 32.65%. This is a move. This is a good, if you make 32% on an investment, that's a good move. And that's probably one of the reasons they're and that's probably one of the reasons these miners are doing better. Now, Newmont, considering they should be doing better, all things considered, and you can see that's probably one of the reasons uh New Gold went from losing money to gaining money. And I hope they start paying down more debt. But anyway, long story short, you can see New Gold has had a much greater increase in net incomes and cash flow than Newmont, and that's why it's gone up more. And so the reason these miners aren't performing as weren't performing well over the years was because they were losing money and they were losing net incomes. It's not people don't go in the miners because of all these other products. If these miners are making money and minting money, people will start investing them and the prices will go up. So do remember that when thinking about the miners. It's not always I remember hearing someone saying the reason the miners aren't doing well despite gold going up, or the reason why the miners is because of their Dow gold ratio. No, it's not. It's because the miners aren't doing well. And I just showed you Newmont and New Gold and why New Gold has gone up drastically more than Newmont. It's because of the finance. This is why it's called finance, net income and cash flow. And I know this is a strange sort of video. It might be like somewhat like duh, but in the gold community, it's easy to get up in conspiracies. And this didn't come to a revelation to me until I just kept hearing about all these other products competing with the miners. But then I asked myself, and this is why I always say, always question everything. I was like, why are the royalty and streaming companies doing so well? Like, if they're taken away from the miners, wouldn't the Dow Gold take away from the royalty and streaming sector? Wouldn't it take, wouldn't Bitcoin take away money from, wouldn't wheat and precious metals and Royal Gold, Franco, those guys, wouldn't they be doing poorly too, like the miners? And I think it does take some speculative money in the gold price away, but it's not why the miners aren't doing well. The reason the miners aren't doing well is because a lot of them haven't done that well. Now, Newmont, as you can see with the net income increase, has improved, and that's why it's up 15% this year. And you can see New Gold, and there's others. I mean, I just cherry picked two. But that is why all those years they've been performing well. And when you're dealing with mining and mining companies, don't forget the basics. Remember the basics of growing incomes, growing cash flows, paying down debt, increasing cash on the balance sheet. I always say that. Just remember the basics. So, anyway, that's all. If you listen all the way through, thank you. Helps the algorithm. And hit that like button, subscribe. Remember, this isn't financial investment advice, just my opinions and my thoughts. And I have more on the disclaimer below.